Joining me now for a look at some opportunities is Stevin Hoover. He's the president of Hoover Capital Management. He comes to us now from our Boston bureau. Stephen, good to see you.
Good to see you, Lauren.
All right, let's just talk a little bit about these numbers today here. It seems to be encouraging a lot of money to be flowing into the market. Do you think it'll back off anytime soon?
Well, you just got some amazing numbers on that unemployment. It amazes me that the unemployment rate can go down like that with no upward pressure or 0.1% pressure on the wage scale. And you see the long bond, it's probably going to go down below 6%, and that's a wonderful thing.
It's a beautiful thing, some might say, actually, right about now. Anyway, let's talk a little bit. You still say that we are overvalued here and that you're basically saying, look, we've had 10 terrific years here. Let's not get too greedy.
Well, yes, you really can't say that the next 10 years is going to be anything like the last 10 years because the last 10 years have been about the best 10 years in history. And you see how jittery investors are, so that any disappointment, however minor, could cause an overreaction, and that could tumble, and it could be very devastating. Look at Disney. Earnings came in right on 10 cents. That's what they were expecting. And then there was a little bit of a warning about next year. But here's a powerhouse company that got hammered today because of earnings that were in line with expectations.
All right, so cutting to the chase right here, you do not expect stocks in the aggregate next 10 years double-digit returns?
Absolutely not.
All right, fair enough here. But you know, with these numbers going as they do, can you blame some of the folks for sitting down at their computers right now and without the assistance of any type of advisement, going ahead and just e-trading away?
I think that's fine. I think that they should watch themselves, because you have to remember that stocks are really pieces of businesses. They're not just raw material for trades. So if you're buying it as a number, you don't know what you're doing and you can get really hurt. If you're buying it as a piece of business for the long horizon, long time horizon, you will probably take the time to know a little bit more about that company and get to understand whether or not you would, if you had unlimited funds, buy the whole company. And if you say, I'd buy the whole company because it's priced below its value, and I'll buy 0.1% of it on the same basis, I think you're okay. But I do fear the day trader, e-trader, the naive investor is the first one to get hurt, and they probably have the highest level of future expectation about the market.
You know, some of those day traders, e-traders out there, Stephen, might say, well, you know, you're the guy who'd be making money if I came to you for advice. How would you respond to that?
Well, I think that's true. I think that if you come to somebody like us for advice, you should do so for the long haul, and you should be conscious of our fee and whether or not we're earning our fee. And it's no secret that the vast majority of money managers have not earned their fee, and not too many have beaten the S&P 500 over the last decade.
All right. Well, I was hoping you would be the one to say that and that I wouldn't have to point that out to you. Thanks, Stephen. But in the meantime, you know, you hit upon another good buzzword, and that's the long haul here. First of all, let's tell everyone what you mean by the long term right now.
How long? By the long term, I mean at least 5 years and preferably 10 years. And our company has held some stocks. Clients know this, that 15 years, I have two good examples of 15 years, and one of them, actually both of them, I'm still very comfortable to be buying right now.
Sounds good. Tell me what they are.
Berkshire Hathaway and ServiceMaster.
Ah, yes. All right. Just real quickly, you think it is time that also the smaller cap stocks may be in for a good run or not?
Well, there's some interesting small cap stocks out there. One example would be WD-40, a $350 million market cap company. You know what they do. They have the squirting lubrication oil, and they also own 3-in-1 oil, and they also own lava soap. And here's a company trading at 15 times this year's earnings. The yield is getting close to 6%. The stock 52-week high was 31, the low 22, and it's about 22.5 right now. I think that for the conservative investor with a long horizon who needs the buffer of a high dividend, that's a great one. And it's a well-known product, and it's very focused.
Sounds good to us. And as always, we enjoy hearing your focus. Stevin Hoover coming to us from Boston of Hoover Capital Management. Good to talk to you. Meantime, we have this just in. We've got Kevin English. He's the CEO of TheStreet.com. Well, the word right now is that he will resign, and the company says that he will be replaced by its COO. And the company is saying that it is remaining on track to meet its financial objectives. And if we get any more on that story, we will bring it to you here. Meantime, straight ahead, we're going to take a look at the day's movers and shakers for you and all the stories.